Glad to see everybody in person. While I think we are more used to virtual summit nowadays, I always prefer the physical one. And now the new word is phygital, where we do both physical as well as virtual. So I'm sure a lot of people are logged in virtually as well. But it's always great to address people instead of placards or standees, attendees. So before we get started off, a little bit about Northern Arc. I wanted to congratulate Aditya. 10 years is no mean feat. So I was saying that 10 years is no mean feat, and if I were to draw parallels with what happened with Northern Arc, I think proof of concept is the first few years. You have multiple ideas, you start thinking, you pivot, you find some success, you go to a different business line, and by the 10th year is when you're firmly established in terms of what you want to do. And that's when the scaling happens. So we see, as and when the events are happening, I see more and more people. I see more and more professionalism in how it's happened. And I have to jostle a lot more to get a slot than to be a participant as well. Earlier, Aditya used to reach out. Now I'm the one reaching out to him. So great to see that and hope to see you with a lot more success as we go ahead. So today I'm going to talk a little bit about the rise of private credit. It's an asset class which has gained a lot of growth in the last few years. We'll segment it into where some of the asset allocation in family office is happening and how Northern Arc's experience in private credit has been for the last few years. I'm sure these are figures that you have seen, heard, and know a lot more about. As Aditya mentioned, so family office as a source of capital, which was very fragmented earlier, right? Everybody was doing their own things, has become a channel where there is a lot more coordination, there is a lot more networking, there is a lot more thought process in terms of how the investments are done. Right? We have a couple of slides ahead which talk about how the allocation within family office has also changed. But today, about 35% of family office allocation is towards alternate investments, right? So if you look at it generationally, the earlier generations were largely about saying gold, real estate, high fixed income because of government schemes, double your money in 5 years, double your money in 7 years, Indira Vikas Patra, this Patra, that Patra. But now it's been about startup investments, it's about risk, return, volatility, liquidity. So these are all the words that have come in the lexicon now. And the professionalism shows in terms of the structure which family offices are following nowadays. Is $30 billion of capital and hence a good, strong balance to institutional as well as offshore capital. So much so that over the last 1 or 2 years, the offshore capital piece in India has become a very small part of dialogues. Right? Even when you go outside, the need to attract offshore capital and the need for offshore capital to support both Indian listed as well as unlisted companies has come down significantly. And one of the main channels is from the family office segment. The another reason where family offices are allocating towards alternates is for the low correlation with the other asset classes. Because once you get to alternates is after you have exhausted all the other traditional asset classes or say listed stocks, equity, gold, etc. Right. So where is the allocation largely? This is the result from a survey. Listed securities, which is more of a legacy kind of allocation, still forms the highest allocation at about 36%. Fixed income has increased, and a large part of the increases over the last few years, especially with interest rates moving up. Right. About the last 5 to 7 years has seen a lot of artificial dislocation in the fixed income market. Right? Started off with demonetization, which saw a huge amount of money come into mutual funds, insurance, bank FDs, depress the rates. Rates started to move up, and then came COVID, and there were a lot of monetary actions which have depressed rates globally. And now we are seeing the reverse of that, where fixed income or interest rates are now making their case to be treated equally with equity and especially competing with a lot of the startup kind of investments given what is happening in the market. So we see a large amount of movement as well in the alternate space. While direct startup investments contribute a large section, about 47%, this is now the rate of growth is tapering. Fixed income is increasing a lot more. Venture debt funds have also picked up, but now the segmentation has increased right from what is early stage equity, what is late stage equity, what is listed equity. Similarly, in fixed income, what is working capital financing, what is capex financing, what is financing with warrants. And there is growth in some of these segments depending on what is the end use at the company level. So a lot more segmentation, understanding of risk is driving an increase in the asset allocation, especially across family offices which are sophisticated enough to understand the end use across some of these choices. Where have the returns come from? 20% allocation to alternatives has driven about 30% worth of returns, right? And this does have some amount of hindsight bias that there were some good startup exits. Probably they may not continue in the near term. But the fact is that a lot of this has been uncorrelated with what has happened with the listed or the traditional investment avenues. So we see a lot more adoption of alternatives. There is a higher degree of adoption of the structure under which you do an alternate investment. So whether it's an AIF, whether it's a venture fund, whether it is through LLPs, whether it is to angel clubs, there is a lot more, like I said, knowledge sharing, network, as well as pooling of resources to make sure that your voice at the table is heard. Right? Because, as an example, if you are a 1% contributor out of the funding need for, say, a company, it is very difficult to get yourself heard and to direct any kind of action within the company. Right? So, how do you become more active from passive? Is by some of these groupings, and hence alternates have happened that way, where family offices and other sources of capital have grouped together to make sure that they can drive changes and have driven a lot of returns as well. Okay, this is largely about things that you already knew, and I just wanted to run through some of these things. We'll get to some of the sections that I know a little more about, and hopefully I can share some perspectives in that. So let's talk about performing credit. What exactly is performing credit? I think a lot of folks would be familiar with the mutual fund segment, especially those who have been here for, or at least haven't been in the investing segment for more than 10 years. Right? Because right after 2008, when there was a liquidity crisis, and a couple of funds in the mutual fund industry were stuck with illiquid but higher yielding assets, that gave rise to the credit risk segment within the mutual fund. And accrual is something that everybody in India understands innately. Right? My parents used to invest, like I said, in the Indira Vikas Patras of old. Right? 5 years double your money, 7 years double your money, 10% return, 15% return. Right? Fixed deposit, simple, hold to maturity, you get accrual. Technically for the credit risk that you're taking, but for us, typically banks are credit free. So this segment really captured the accrual demand from investors, put it in a wrapper of tax efficiency and anytime liquidity, and this gave rise to a high amount of growth. Right? So the mutual fund segment on credit risk funds grew to 84,000 odd crores. And this is exactly what performing credit is. This is about giving money as lending to companies which have proven unit economics, have proven their existence and are largely scaling. So they need it for working capital, they need it for capex. Banks were one source, mutual funds came as the second source, right? Insurance doesn't really participate in this segment. These are three main sources of capital in India, and a large part of us being channeled through the mutual fund segment. Now cut to October 22 at the far end of the graph, and this has reduced significantly. I know almost everybody knows the answer on why this has happened, but let me try to put it in a meme format, right? And that's this thanks to social media, that how much of a technical explanation you may do, things are much better captured if you just have a one line or a meme answer to it. So I'm not sure how many are familiar with Hindi movies, but there is a famous dialogue from the movie Dabangg. It says that, थप्पड़ से डर नहीं लगता साहब, प्यार से डर लगता है. Right? And I was reminded of that meme as today in the morning only when I was trying to book a cab. And one of the famous memes is that Uber driver से डर नहीं लगता, cancellation से डर लगता है. Similarly, in credit, we have a meme which says that default से डर नहीं लगता, redemption से डर लगता है. And the underlying investments in all of these mutual funds were not the ones defaulting. You had a small percentage that was defaulting, which is 2% of the portfolio, right? Or 3% of the portfolio. But the redemptions that it triggered when everybody rushes to the door is what has led to a scheme being shut. The fact that you're trying to do something which is out of the market. The stock market is a liquid market, especially in the top 100, top 200 kind of companies. Anything else is illiquid. Within fixed income, only government securities are liquid, that too not all of them, and some select AAAs. You try to provide liquidity on names which are not liquid, can lead to a problem. And this is exactly what happened with mutual funds, right? So the wrapper really matters. And in this case, the wrapper of an open-ended mutual fund, which does not have any mechanism of providing the liquidity that it promises, led to this kind of decrease. So it's not like the underlying thesis is wrong, right? Once the funds were shut of one mutual fund which had to resort to closing down their schemes, all of the investments performed, money came back, including returns. Right? But as such, mixing it in an open-ended structure was the biggest challenge when it comes to performing credit in a mutual fund wrapper. The other is that when you start lending or investing to companies that are not as established as, say, an HDFC or a Bajaj Finance or a Hindustan Lever, etc., right? When you start lending to companies which are more new to market, right? So, say if you lend to, say, a raw pressery or a product like a soulful kind of a food product, which may not have the entire distribution, etc., set up, it needs a lot more work. Right? It's almost private equity types in terms of diligence. For that, you need to spend resources. Right? If you try to do everything yourself, then it is impossible to do so unless you have a huge army of resources. Right? So it's like akin to saying that when you're running a family office, you should be able to do investments on your own directly in early stage equity, late stage equity, listed securities, cryptocurrencies, gold, real estate, fixed income, everything. It's not possible. Similarly, in mutual funds also, when you're trying to do duration, when you're trying to do AAA, you're trying to do macros, you're trying to do also credit within all sectors, steel, cement, industrials, F&B, etc., with a 3-member team or a 5-member team, it is not possible unless you spend that kind of resources. So specialization matters a lot when you're really going down the curve in terms of allocating to credit, right? Now, what exactly is performing credit from a segmentation perspective? And everybody understands numbers. So if you look at the table on the left, there are 3 main segments. Sorry. Everybody understands the AA, AAA segment, so I'm not going to speak about it. The 8 to 16% is the performing credit segment. So these are operating companies which have proof of concept, which have a running business, which have an accounts receivable. There are people consuming its products. There are people who are paying that company, and they have a business model, right? And they are growing. Then you have the 16+%. Now, a company cannot pay more than 16% plus on a regular basis and still make a lot of profits. Right? All of the money that have come from family office now, you know that in the running business that you have attached to, these kind of margins are impossible to sustain for long. Right? Can you generate and keep paying 20% kind of cash flows or interest on anything? Used to happen for some time in real estate, but now it's not possible. So this is called situational credit opportunities or special situations, where it's a leverage buyout, it's a holding company which is infusing capital for a limited time in a performing company. It's a merger between two. It's a loan against shares. It's a loan against brands. So all of these kinds of situations, right? Similar to, say, a takeover financing, which happened with a cement company now as well, right? So these kind of opportunities will give you 16% plus, but they will only last for 12 to 24 months because nobody can sustain paying those kind of yields for long and keep running a business, right? Because these kind of margins are just not there. Within the 8 to 16% part, these are companies which are at the growth stage. They are continuously growing and they can afford higher forms of financing for the next 2, 3 years, but they are at positive cost economics. Right? So this is the segment where you are lending to companies which are not as risky as a startup or as a situational finance. Right? This is where a large part of the banking market in corporates also lends. And here, for private credit, diversification is your friend. Right? So it's very different on how an investor should think about diversification. Right? In equity, diversification is your enemy. Right? I have $1,000 to invest. I put on one company, it gives me 2x returns. I am happy at 3,000. In fixed income, in a diversified portfolio, if that company defaults, then I have zero or nothing. If that company in a portfolio was only worth 5%, so out of that 1,000 rupees, if I only put 50 rupees in that company, if it gives me 2x returns, then I only made 1,100. Right? But if it defaults, I have only lost 5%. Right? So if the portfolio is giving you 10% plus on an annual basis, and a single company share is only 3%, then even if a company defaults and you get nothing back, you have still not lost capital. In fact, you have made returns higher than what a AAA would do. Right? So that is the kind of run rate that you look at. In performing credit, diversification is your best friend. In equity, it depresses all the other returns. So you have to decide on what is the level at which you would like to invest. The other good part about performing credit AIFs is because these are companies which are throwing up cash flows, they can return cash flows to the investors as well. So the structure is that over the life of your investment, you're continuously getting cash flows. Right? It's very different from an equity or a hold and pray kind of investment. And the segment is growing a lot. How are the ways to participate? Either you can do it yourself with a direct participation, you source, you're connected to the markets, you figure out which are the companies which want financing on what kinds. The companies think that you have a check size that they will cater to you. You compare with all the other companies that are raising funds at the same time. This is pretty intensive exercise, but if you're plugged into the market, you can do it yourself. Right? It's like how during COVID, everybody was baking bread themselves. Right? Time tha tabhi. Right? Now nobody does that. If you have the time, if you have the ability, you can do this. Right? The other is you go through a arranger or somebody who is sourcing for you. Right? In investing, there is sourcing, there is then diligence underwriting, and then there is monitoring. Right? The first option, all three is something you're doing. Second option, the sourcing is done by somebody who's trusted, but may or may not have skin in the game. Right? It's like a postman. It's showing you a deal, it's your money, and they're getting a fee for it. Right? And Northern Arc operates across all these three segments. And the third is a specialized fund manager, which is the famous fill it, shut it, forget it kind, where you engage somebody whose job is to only do this, is a professional at a certain level of fee. So you pay for expertise. Expertise is pretty cheap in funds nowadays because of the high amount of competition. So typically you cover that in pricing as well. Fund management fees in India have moved to global standards at about 1 or 2%. So coming to briefly on Northern Arc Group, like I said, we do all these three kinds. We have a direct participation platform, if you look at the bottom right of your screen, which is called Altify, where somebody can log in and invest directly in debt, suited to your tenor, suited to your risk appetite, whether you want 1 month exposure, whether you want 3-year exposure, whether you want tax efficient exposure with market linked debentures, or whether you want cash flow throwing companies. All of those are available. We also do syndication, where if somebody wants to invest along with us in a company, then those opportunities are also available, all the way from 8% to 16% kind of returns. And this is something that we've been doing for over a decade. And we have a fund management arm as well, which runs both alternate investment funds as well as portfolio management services with over 4,000 crores of commitments and investments. This is something that we have done for the last, I think Northern Arc Group is now 12, 13 years old. The funds business is about 8 years old. So we are right where Aditya is in terms of vintage. Track record speaks for itself. So we are I would call it one of the old asset managers in the relatively new space of private credit. Yeah. So this is largely what we've done so far. We've done 8 funds. 4 funds have fully matured, invested, given the money back. Not a single fund where we have not delivered committed or indicated returns. Typically, the circle on the right is where the post-expense returns are at. We are not as well known in the high net worth or family office segment as the institutional segment because a large part of our LPs are institutions, whether it is banks, insurance companies, mutual funds, overseas funds from Europe, US, and some foundations, etc., from India. Uh, Over the last few years, we've also made inroads, especially via the PMS product, across the high net worth individual segment. So I'm just rushing through a couple of these things to try and keep it at the 20-minute segment that they asked me to. I mentioned this one point on resources, right? The amount of work that you have to do to protect your money really is a driver of the outcomes. Familiarity and the more effort you put in understanding who wants the money, why they want the money, what is the kind of structure, how many resources can you put in for monitoring, and then if you want to exit, if you know that market well, will drive you the returns. It's very easy to allocate money. Is the next part that matters, right? Over the last 6 years, we have seen multiple crises. We've seen demonetization, we saw GST, we saw the IL&FS crisis, we saw COVID crisis. And across all of these, companies have suffered, companies have defaulted, companies have recovered, and exits have happened. So we have a very intensive investment sourcing, underwriting, and monitoring kind of framework. Largely possible because we run multiple businesses of both syndication as well as direct investing, which is what allows us to have 200-300 people to do the same thing only across a few sectors. Right? So we understand a few sectors, we only work in those. We don't work in real estate or some of these other traditional sectors. Yeah. Just the last quick slide on what is our shareholding or what is our ownership. With growth comes private equity, and hence a large part of our investors at the fund level and at the parent level. We run an NBFC-oriented fund, our private equity funds. When they want to exit, which is hopefully soon, we will be listed on the public markets as well. We have already filed with SEBI, and we are at that stage that we will be at a IPO soon. Great. So thanks a lot for your time. Hopefully you had a couple of things that you took away from this session. Sorry for having to rush through some of these things, but rather that we stay on track and on time. Okay. If you have time, I can take one. Sure, sir.
What the industry is doing about the transparency, bringing transparency either in investment fund. Because when we talk about the PE fund, we are talking about RE fund. These are the funds where there is no transparency, unlike mutual fund or direct equity, where you are aware that what is the movement of the NAV, whether it is going up, going down. In case of AIF, what you get is only on quarterly basis a newsletter where they are giving 1.2, 1.3, 1.4. I had invested in the private equity fund, real estate fund at the time when the market was at bottom. Obviously, investment was into unlisted securities, but then pricing also was at bottom because it was immediately after the financial crisis. And then the fund was meant for a period of 7 years, reputed fund. And that 7 years, the exit did not happen. Plus 1 year, another 1 year, and finally what I find, the return were not even 2 times. In real estate fund, it was not even the principal which was returned. So what is that industry is doing to bring remove the opaqueness and bring transparency on the AIF front?
I feel your pain. A fantastic question and very relevant one. So give me a couple of minutes to just go back into history as to how the industry was also started, right? In 2001 to 5, at that period, we had the VC regulations that governed how pooled capital can invest in unlisted space or in names which are not listed on the markets or are not as well available, right? This was replaced by the Narayan Murthy Committee in 2012 with the AIF regulations, which brought a lot of standardization in terms of saying that let us provide investment managers such as us the flexibility to design a product which reflects the underlying. Right? So one of the examples of open-ended mutual funds was like that. Right? It's not really suitable for a real estate kind of investment. Under AIFs, under the three categories, you can pretty much do any asset class, whether you want to take leverage, whether you want to take cryptocurrencies, whether you want to do anything, right? Whatever is legitimate. To provide that kind of flexibility, there are certain responsibilities that are placed on an investment manager. There are certain kind of responsibilities that are placed in terms of the diligence done by an investor investing into this as well. Right? As such, out of the bat, the regulations have been extremely good. Right? They have provided a lot of investor rights. They've not needed to be changed a lot. Right? If you see in terms of the number of changes that have happened in mutual funds, if you compare that with the AIFs, AIFs have not really gone through as many changes from a regulatory perspective. Right? And I'm on the SEBI committee for AIFs as well. Now, when you provide this kind of flexibility, there is invariably some amount of abuse as well. Right? And we do have, in the guise of providing flexibility that you can have limited disclosure, there are AIFs which do not disclose much amount of information. There are AIFs which have used regulatory arbitrage, and some of the circulars from SEBI are testament to that, in terms of using that structure to push through certain practices as well. Right? The initial assumption under all of these regulations was that the industry would self-regulate, it will come up with better norms, better standards, so that it aids the growth of the industry, right? And I want to make a mention of Northern Arc. Right from our first fund in 2014, we've declared daily NAVs, we've declared monthly fact sheets, keeping with the mutual fund segment. But we don't make the entire AIF industry. We may be just one of them. And the industry has not responded the same way. Right? So giving the flexibility to declare it only, evaluate only once in 6 months, etc. and all, has now led to undesirable consequences like the one that you mentioned. Right? I'm not going to talk about the performance of the investment because that is related to the underlying. Right? But the regulator has taken note. There is a flurry of things which have come about with respect to greater disclosures, greater transparency, greater do's and don'ts, which are now being specified as to what can and cannot be done in consultation with the industry associations. Right? So there are a couple of associations which have pulled together AIFs. We are working with the regulator as well. All of this transparency is coming. Some of it is already there. Benchmarking was something that came in. Valuation, NAVs, this is also coming. Disclosures, investor rights, ensuring that all investors are treated at par and there is no specialized treatment which is not captured. All of these are now coming as a push from the regulator rather than saying that you figure out yourselves and make sure that when you design an AIF, the onus is on the investment manager. So it's now shifted more to the regulator in consultation with the AIF industry, where a lot of these improvements have happened and are happening continuously to make it on par with or surpass in some cases with what the mutual fund industry is doing. And it comes with growth as well, right? Today, now we are at 6 lakh crores in terms of commitments. The industry is growing with leaps and bounds. And hence, all of these things are needed to make sure that there are no bad accidents which will derail the growth. So things have changed. They are changing more. The regulator is also pushing. And the AIFs, which as part of an association think that this kind of transparency only leads to additional growth, are also at the forefront of doing so. Sure. Thanks a lot, everyone.
A big round of applause for him, everyone. And with that, I would request Mr. Aditya to felicitate Mr. Ravi. Thank you so much for that enlightening session.